Hype ETF inflows are outpacing Bitcoin and Ethereum, Grayscale says. Grayscale says the exchange-traded fund tracking Hyperliquid's Hype token is drawing inflows at a faster clip than the ETFs for Bitcoin, Ethereum, Solana, and XRP managed at the same stage of their own life cycles, measured on a market cap basis. The claim was shared by Cointelegraph on July 28, 2026, citing Grayscale data. The framing matters more than the headline. Grayscale is not saying Hype has pulled in more total money than a Bitcoin product. It is saying that if you line up each fund at the equivalent point after launch and adjust for the size of the underlying asset, Hype's early inflow curve is steeper. That is a statement about pace and relative demand, not absolute scale. The comparison Grayscale is actually making lifecycle normalized comparisons strip out the advantage that older, larger assets have simply from being around longer. A Bitcoin ETF sits on top of an asset worth over $1.2 trillion. A fund tracking a newer token like Hype is working from a much smaller base. Comparing raw dollar inflows would tell you almost nothing, since Bitcoin's product operates at a scale nothing else in crypto can match. By putting everything on a market cap adjusted basis and aligning the clocks, Grayscale is isolating one variable: how quickly capital is choosing to enter each fund relative to what it tracks. On that specific measure, Hype is ahead of four assets that anchor most institutional crypto portfolios. The obvious caveat is sample length. Early inflow curves are volatile, and a steep start can flatten fast once the initial wave of interested buyers clears. Infrastructure tokens are catching a bid. Hyperliquid runs a high-throughput derivatives exchange built as its own chain, and Hype is the token tied to that system. Demand for a Hype product reads as a bet on the venue's activity rather than on a store-of-value narrative. That distinction is the interesting part of the data point. Bitcoin ETFs sell an asset allocation story. Digital gold, portfolio diversifier, macro hedge. An ETF wrapped around an exchange token is closer to buying equity in the rails themselves. If institutional money is entering that kind of exposure faster than it entered the majors at a comparable stage, it suggests some allocators want the growth attached to usage and fee generation, not just price appreciation on a reserve asset. Whether that preference holds through a full market cycle is untested, since infrastructure tokens carry sharper drawdown risk when trading volumes dry up. The timing cuts against a soft tape. As of July 28, 2026, Bitcoin trades near $63,300, down 2.6% on the day, with Ethereum around 1,879, down 3.2%, Solana at 73.31, down 3.8%, and XRP at 1,006, down 4.1%. The Fear and Greed Index sits at 34 in fear territory. Inflows into a newer, higher beta ETF while the broad market slips is a divergence worth flagging, though a few sessions of data does not make a trend. Reading the number without overreading it. One measurement from one issuer is a data point, not a verdict. Grayscale has a commercial interest in products that attract flows, so the comparison should be treated as a marketing-inflected observation until independent flow data corroborates it. Life cycle normalized charts can also be sensitive to where you set the start line and how you handle market cap adjustments. For crypto users, the practical read is narrow. ETF inflows do not change how anyone spends a token or holds custody of it. They are a signal about where regulated capital is willing to go, and right now a slice of it is testing exposure to an exchange token faster than it tested the majors. That is the story. It is not evidence that Hype will outgrow Bitcoin or Ethereum in dollar terms, and nothing in Grayscale's framing claims that. The pattern echoes a broader shift, with crypto ETFs increasingly competing on cost and access and pulling regulated money into narrower corners of the market than the first Bitcoin funds ever reached.